Major funding for these broadcasts has been provided by grants from Madison Realty Capital, Capital One Bank, Eastern Consolidated, New York Community Bank, M&T Bank, Sterling National Bank, Meridian Capital Group, Customers Bank, AmTrust Title, Ariel Property Advisors, Dime Community Bank. Additional funding has been provided by AVR Realty Company, Bank of America Merrill Lynch, Briarwood Organization, CBRE, Chase Commercial Term Lending, Chase Mortgage Lending, Citizens Bank, CPEX Real Estate Services, Colliers International NYC, Collins Building Services, Douglaston Development, Levine Builders, Flushing Bank, Friedman LLP, Handler Real Estate Organization, Handro Properties, Hodges Ward Elliott, Inc., Investors Bank, James D. Kuhn Real Estate Institute at Syracuse University, Kilroy Architectural Windows, Matone Group, Mercantile Bank, New Banks, Newmark Knight Frank, Optimum Window Manufacturing Corp., People's United Bank, Rockefeller Group, Rosewood Realty Group, SJP Properties, Stonehenge NYC, TD Bank, Terra CRG, the Meringoff Family Foundation, the Moynihan Organization, Moynihan Capital Partners, and these friends.
Summer 2018. Lots of money out there for real estate. Lots of money out there. So today, with the help of my executive producer, Mr. Levine, we've assembled this group of capital markets experts to provide their insight on money for real estate. As I said, my guest is Ronald Levine, Senior Managing Director at Meridian Capital Group. Chris LaBianca, Managing Director, Head of Originations for UBS Investment Bank. Returning to my show, the kid from Florida, Tony Feynman, Head of Originations for Acor Capital. And last but not least, the Managing Director at Lone Core Capital, Brett Kaplan. So since you brought this group of illustrious individuals, how do you see the market today?
The markets is flush with cash, as you mentioned in the intro. I think there's a lot of liquidity in the market, specifically for floating rate deals. There's been a lot of capital. You know, from our perspective as an intermediary, it's a challenging market to just keep up with all the new entrants that are coming in. There is a lot of
Wait
capital.
a second, isn't that a good thing for you?
It is a good thing, but you look, we want to make sure that we're finding the most efficient cost of capital for the borrowers, and we're getting them in front of the right sources of capital. So there's just, you know, there's a lot of new entrants into the market. We need to make sure we understand their lending platforms. We need to make sure we understand how they're differentiating themselves from the other people that are already in the market. So you want to make sure that you're balancing the certainty of execution with a new guy that's coming to the market with maybe some cheaper capital. So it is challenging.
So how do we consider each one of the individuals over here? What's your specialty? What's Lone Core Capital doing today? What's your niche? What do you feel comfortable at?
We do both fixed and floating rate balance sheet loans. We're really following a risk retention model where we're maintaining the risk position on all of the products that we're offering right now. So fixed rate CMBS conduit. We're going to aggregate a pool, hopefully of the majority of our collateral, and we will buy the B piece on that entire pool. So we'll be the risk retention holder for that type of transaction as well. So
now we ask the tough question. Explain this to the consumer who doesn't understand what you just said to me.
Now basically it's been mandated that there's a risk retention party who has money at risk, and you can satisfy that one of two ways, either vertical or horizontal. The banks generally, a lot of them have been following the vertical, where they're basically owning a vertical slice of the entire securitization from AAA all the way down, or you can do a horizontal piece, which is the bottom 5%, or you could do basically an L or some combination of those two.
So we're basically talking more about the CMBS, the collateralized mortgage-backed securities.
Commercial mortgage-backed securities model. That's the fixed rate side of our business. That's the the model that we're following. So we're making all the credit decisions on all those loans, and it's a natural, because of the balance sheet business, which we've been running for a while as well, and is really a bigger side of our business. It's probably 3-to-1 today. Floating rate lending to fixed rate lending, where we're also the risk retention holder. It's a balance sheet product. We have a fairly decent sized balance sheet, and we're holding all of the risk, even though we may finance those either with warehouse lines, or we just did a CLO as well. We're still holding the majority of the risk position and making all the credit decisions on that.
And you, Tony?
We're not in the fixed rate business. We are strictly in the floating rate business, and we do everything in the bridge space: land, a little bit of land, construction.
Are you holding the risk? Are you taking 100%?
We hold the bottom. We hold the bottom, in some instances, all of the loan, depending on what pocket of money it's going to.
Chris?
So we're in a similar space to Brett, but at a different point. As a full-service investment bank, we're an issuer of CMBS. So we're actually originating for securitization. We take in partners, other banks, other non-bank intermediaries who provide collateral to our shelf, and we issue bonds off our shelf. We also run a warehousing business where we're financing bridge lenders and providing access through the CLO market.
So you're lending to Mr. Feynman's company type?
Companies like
his.
We'll have to talk afterwards.
I agree that we're not sure that the credit criteria is for him.
Come on.
For other people like that. How do you make the determination, since you have all three individuals who are all gentlemen, who are all basically priced competitively near each other, I would say? How do you make the determination who's the best guy to do a loan? You think I was going to make life easy?
No, I mean, it's a fair
If
question.
I want to do it, then it's my deal, right?
So look, I mean, Chris and Brett would compete on the fixed rate product only. There's very little crossover on their floating rate product. Tony and Brett would compete solely on their floating rate product. So, look, we go out to, we will canvass the market, get back in a variety of bids at different leverage points, and it really depends on what the client's looking for. We're going to look at the transaction, understand what the client's business plan is, where they want to be in terms of leverage, what their hot buttons are. It doesn't always come down to just leverage and pricing. There's other structural considerations in these loans, and there's a lot of other flexibility in implementing the business plan that can be very important. So it's hard to distill it down to kind of just the economics on a deal. So really what I'm trying to do is find the lender that matches or marries up best with the borrower's business plan. And sometimes that could be 2 or 3 lenders that are very similar. And ultimately for us, we'll have a discussion with the borrower in terms of ease of execution post-closing, the servicing differences between the lenders, who's going to be the most user-friendly through the closing process. And oftentimes I think we get too much blame and too much credit for who the transaction goes with. The borrowers have some pretty distinct opinions and relationships that we have to navigate. But look, this crew of lenders are core lenders for us, and I would be comfortable doing a transaction and have done billions of dollars of business with all of them. So, to us, it's really just making sure it works.
Well, one of my comments that I asked when we were in the green room was, how do you make a determination, the lender, okay, not Ronnie on this, how do you as a lender, okay, where you're taking a portion of the risk, all of you are taking a portion of the risk, how do you make that determination of that's the new person I want, the new horse to follow?
Listen, the core for us is a nexus to wealth management. Our institution is driven by being the largest manager of wealth in the world, so if we're going to do a real estate transaction for a new client, it's going to be someone that there's some nexus to wealth, a wealth management relationship. We're going to be wanting to do other business with them other than just a one-off real estate loan.
Okay, so basically a new kid on the block, unless they have some wealth behind them, they're really not the primary character that you want to lend to right now.
Correct.
I mean, I think you just said something that I think is very significant. I mean, the lack of experience is not on the positive side of the ledger, but you know, the deal. If we like the deal, we like the basis, we like the sponsor's experience. That's not necessarily as a principal, but experience in the business. I think that it's hard for us to lend to someone that doesn't have the financial wherewithal to execute. So if you're talking about someone, and you kind of mentioned this, that doesn't actually have capital to execute a business plan, that's going to be hard. The fact that they're new is not in and of itself a reason not to do a deal. It's just something to consider. So,
Brett?
Look, equity cures a lot of things. So if, you know, we like the basis, as Tony said, and they're putting in a reasonable amount of equity, that can be great. If they want high leverage, then, you know, it becomes a little bit more potentially complicated. But you're really looking at, I think, how heavy of a lift is it? Right. A lot of deals, there's not that heavy of a lift, and you know, it's a relatively clear path to, you know, where they want to go, and you feel like they're capable based on what they were doing before. And we love to find those guys, because if they're successful and we can get in early, build a relationship, those are the guys hopefully who will give you, you know, the benefit of the doubt when there's a bunch of competition for their deals, you know, 1, 2, 3 years down the road. And you want to be able to call them up and hopefully have them remember, you know, what you did. Of course they do, but it's nice to have those kind of relationships if you can find them.
Are we a little worried about potential recession? Are we worried about interest rates going up? I mean, we've had a couple of times this year that the Fed has raised the rate. I mean, you underwrote it at a couple of times, a different number. How are you taking that into consideration in your debt yield and your overall projections for the takeouts later on?
I think we've talked about how competitive the market is, right? But I think that competition has largely been on pricing and not on underwriting. I think underwriting's held up pretty well, particularly if you compare what's going on today to pre-crisis. So I don't think a lot of people are stretching unreasonably in terms of, you know, trying to win deals, maybe structure around the margins, but in general, underwriting has held up. So, you know, rates will go up, but I think there's, you know, some built-in cushion in current cap rates to absorb some rate increase.
What about leverage?
I mean, I think loan-to-cost leverage is a good barometer. Loan-to-value leverage, I think, is
loan-to-cost. I'm taking loan-to-cost because loan-to-value, what's the value?
People use that when they say leverage, they talk about loan-to-value. I mean, loan-to-cost leverage is a good, you know, that's what Brett was saying before. I mean, if you have someone that puts a good amount of cash into the deal, then there's cushion.
But how much leverage would you allow?
Well, I think
what's 70%, 75%?
What's gone on in the, particularly, I think that's where the capital markets are efficient, right? Because the capital markets will take any transaction and sort of, you know, carve it up and allocate the risk to different parties.
The different tranches.
You'll have an A note, you'll have mezzanine, you'll have, you know, different classes of sub-debt at different levels of risk and different levels of return. So it's gotten much more efficient from that perspective than if you go back to the days where banks would just make a 70 or 75% loan. Now that loan might be 80 or 85%, but it might be 55 or 60% on the bank's books.
Yeah, we're not a bank, so we don't have the lowest cost of capital, right, to do low leverage, you know, inside, you know, 200 or 150 off deals. All things being equal, we'd rather probably lend a little bit more leverage and go up to 80 or even 85% as long as we can get paid, you know, commensurately for the increase in leverage, because we know not everybody can compete at that level. And some guys, some borrowers want the leverage. They want to know, you know, if they're evaluating whether they bring in an equity partner or potentially, you know, a separate mezzanine. Sometimes we can, you know, be an alternative to that and you know, get paid appropriately, and that's a, you know, a good spot to be in.
I think he brings up an excellent point. I mean, we see borrowers wanting to push the leverage if they may need an institutional capital partner at a lower leverage. If they can get the leverage up to 85, 87, maybe 90%, they can do it with their own cash and not have to have a limited partner in the deal, and they can own 100% of the economics of the deal. We've seen that as a consideration that people are looking for. But I think if, you know, Chris also made a good point about kind of the different tranching of the capital stack and the pricing of each of those, you know, tranches of debt. But I mean, I think you know, the kind of simplistic math is that at any tranche, if the returns on that tranche are, you know, are cheaper than, you know, what the projected returns of the deal are, you should just keep borrowing, right? I mean, you're just leveraging, in theory, your return. You know, so we've definitely seen an uptick in from at least the packages that are coming in. The appetite for leverage is growing on the borrower side. I mean, we're definitely seeing
because it's very inexpensive.
What about construction financing? How do you see that? I mean, because construction financing, you're playing on projections. Okay, the question is, it's a projection. Some of them are realistic. I mean, you could.
I mean, it's very similar to the projection you're making on the deal being in the same place a year from now, right? I mean, we don't really project growth when we do. And I bet you most of these guys don't project.
But I'm
growth.
talking about new construction from ground up.
Right, I understand.
Okay, you know, we're talking about the condo market. We're talking about the rental market. We're talking about the office market. How do you look at the different markets, especially for the construction risk?
We're generally not doing ground up construction. There's an exception to everything, and we've been involved in a couple of deals where there are. But we do a lot of stuff that looks more like there's a construction element. It's heavy renovation, those type of things.
But your choice not to do ground up construction is not because of the risk associated with it as much as it is the. Is that right? Or?
It is part of the risk. I mean, I think, first of all, it's a specialized industry, and you have to be willing, in my view, and I think a lot of the people that I work with, you have to be willing to step in and take over construction, and that's a very specific background. You know, we don't have a tremendous staff. We're still, you know, a relatively small private equity firm, so to go in and have to handle one of those projects, it's also administratively, you know, cumbersome. So I think that's part of it. But it is, you know, you're taking an execution risk that they can get it built, and it generally, you know, it's not a linear increase in the risk, right? If you're talking about, you're worried about the market, you're worried about interest rates, you're worried about recession, and you're talking about a 12, 18, 24-month construction period, right? You're pushing that out.
But if you bring it back to the other thing, the other side that we were talking about, I mean, you're not going to be agnostic about what components of the capital markets, capital stack are behind you in a construction loan.
No.
You don't want to see, okay, we'll be at 70, but we're okay with three different players making up the mezz and the sponsor having 5% in the deal. That's not how you look.
No, I'm talking about construction in general.
Yeah, no. But my point to that is we like construction. You know, especially us. The thing we don't like about construction is that the money doesn't go out right away.
That's true.
You don't get paid for it until it goes out. So that's a nuance of the kind of lending that we do. But we like construction. We personally like construction where we play in it, right? Because we play 65, 70% of cost, usually sponsors that have executed, that have the capital to execute, and you get paid. I mean, you used to get, a year ago, you got paid a lot more of an arbitrage to do construction, but you're still getting paid to take, I mean, there is a little more risk, but I think what you get paid is not commensurate with the extra risk that you're taking.
Well, I think
you're getting paid more for the extra risk.
The construction lending market used to be pretty cheap, right? You'd sign with, I mean, at the banks, you're signing with, what, 20, maybe 25% recourse, and you were getting a pretty cheap deal. I think everybody's realized now the market prices it differently.
Dodd-Frank changed all,
yeah.
right? So once Dodd-Frank, you know, kicked in, you know, the banks pulled back on real estate construction lending because of the capital charges. That
changed.
And that has allowed guys like these guys to come in and you know, earn an excellent return for the risk, I think.
Well, look,
now that's, you know, that's just recently been changed.
Yeah, I mean,
it just passed last week.
So
you know,
be interesting to see what happens now.
So I think what you'll see is some of the loans. I don't know that it's going to have a huge impact because of the risk profile of construction lending, but where it will have an impact is for banks like us who weren't necessarily in the construction lending business, but we were looking to do bridge loans, and a lot of those bridge loans, if they had no cash flow, were classified as construction loans, and so you had to hold higher reserves against them. You pulled back in that space. Now there's been clarification around that, and they won't have the same reserve treatment, so you might see more banks step back into that space.
I also think one of the big changes in the HVCRE that came across from the new legislation is that the 15% cash equity, 15% equity requirement used to be purely cash, so there was no imputed value
to the land.
So if your grandfather gave you a piece of land and you had zero cash basis,
it's totally changed.
But they changed that. But that's an important change, and also your ability to take cash out of a property once it starts cash flowing. They ease the restrictions on that. So I think those are important changes in HVCRE.
But look, you drive around New York City, the boroughs, a lot of other places. There's certainly no curtailment of construction. I mean, construction is booming in a lot of places. So you can't say that that's really been you know, a problem, and it'll be interesting to see now with this looser standard.
I just think the cost changed.
Yeah.
That's all. It didn't. There wasn't a lack of availability. It just became more expensive.
Land
A year and a half ago,
valuable.
there was a lack of availability.
Yeah, look, I mean, I still think you need to, you paint with a very broad brush, but when you start to talk about for sale condo, hotel, there are certain asset classes where construction lending is still challenging. It can be done, but it's going to be, you know, you want to, the lenders on a hotel construction loan or a for sale condo are going to ask a lot of questions. There's going to be a lot of analysis done around basis, around supply coming into the market. And it's not easy, but there's enough capital in the market today that you can usually find a way to get those deals done. But you know, the senior lenders have, you know, the banks have been active throughout the cycle. It's just they're oftentimes behind the scenes providing leverage to Tony or maybe to Brett on an A note or a loan-on-loan financing or on a warehouse line that you're not aware of. But the banks are still very active in construction lending. It's just not like where it used to be where they were the lead. Oftentimes they're behind the scenes.
Here's a question which is a little different. Okay, we're talking about hotels. As a lender, how are you looking at properties that have too much Airbnb potential market on that? And how do you look at properties that have WeWorks and other co-sharing?
We do a lot of lending on hotels, and it's primarily in secondary markets, secondary and tertiary markets, and it's almost exclusively for CMBS. So we see less impact from, you know.
Right, because you don't have the major metropolitan areas.
That's right. So that's where we've focused our hotel lending.
I think it makes you, as a lender to hotel product in those markets, just more cautious. You want a little more money in the deal behind you. You want a little, you know, you want a sponsor. It makes you emphasize the other parts of the deal, right? I mean, instead of being at whatever, I'm making up the number, $450,000 a key, you want to be at $250,000 a key, right?
Right. You're reducing your exposure.
You're reducing your exposure so that you can account for those issues. And for frankly, what really this all means is that rates are going in the opposite direction.
And what about the co-sharing?
You're relying on somebody who has to run an operating business, right, for them to be able to pay your rent versus a good credit or a corporation who doesn't care where they make money in that location. And I think that dynamic changes the lending analysis, and so you're really, you know, and you're looking at 100% right roll or default risk on a tenant versus, or at least a lot of the times there's a significant portion versus a more staggered, you know, rent roll, and that brings in other challenges when you're a lender. And I think, you know, particularly with some of the other startups who, you know, don't have the same capital, you know, and equity base, it is challenging right now. So you want to look at your basis really hard and where are they going to be, right? And when if they go out, what are they doing to the building? What's your basis going to be with hopefully a renovated, you know, building, and how liquid of a market is it?
You don't lend to, I mean, we have a good amount of WeWork exposure. I mean, relative to our portfolio, it's not a high concentration, but we have several loans that have a significant amount of WeWork tenancy in them, some all WeWork tenancy in them. And you can't lend to WeWork's business plan. You have to lend to a business plan that is more conservative, that makes sense.
I believe they're the second biggest tenant in New York City now.
They are. Yeah. I mean, a number of years ago, the big CMBS lenders did a lot of retail. Now, with the situation today in the retail market, you know, with the Toys R Us going out of business, with Sears closing many of their stores, with even Kroger and the other, how are you looking at the retail marketplace? Still
do a lot of retail in CMBS, although it's been curtailed. You know, 2 years ago, maybe it was a $350 a square foot mall was seen as a good mall. Then it went up to $400. Now it's $500. You don't really see malls get securitized below sort of $500 a foot in sales.
It's top tier sponsors who are getting those deals.
And the rest of the space has really been, you know, ignored. But your bread and butter retail is still getting done. I will say, you know, when you're selling a pool, you have to be very conscious of your retail concentration, and some buyers of subordinate debt will put in specific caps on how much retail they want to see in an overall transaction. So that's been a function of, you know, what's gone on in retail.
How about you?
We have very, very limited retail exposure. You know, we're not adverse to looking at them, but I would say probably that's the product that you have to be the most cautious about today.
Ronnie?
That's just another sector I think people tend to paint with a broad brush, which really needs some more nuanced analysis. I mean, grocery anchored retail is still very much in vogue. You've got, and also retail, you know, if you've got good data, store sales, you know, to your point, sales per foot and occupancy cost analysis, I think there's
Which
some.
means a strong
But the
location.
problem-
All that means you're at a good location. And luckily, with retail, you have sales that can help tell you whether that's a good location.
Okay,
Can
so
I,
don't
can I want to say something about the grocery? I agree with you that it's painted with the broad, and that's my point to being, you have to be more cautious today to lend even to a grocery anchored center than you would have been, you know, 5, 10 years ago, right? And the grocer might be doing very well, but if they have too much shop space, where are all those tenants coming from? There's not as many
People want to
tenants.
see the service tenants, right? They don't want to see the apparel tenants.
I mean, it's
They
changed
wanna
a lot.
see-
I joke with people all the time. It used to be when we started, when we were in the business together, you know, you didn't want to do a deal that had a movie theater in it. Now today, a movie theater is the
Entertainment.
anchor.
Well, look, there's
or
Right.
Gyms.
Or gyms.
Yeah.
Right. I mean, today, when you have those kind of tenants that you actually cannot replace I shouldn't say that, with Amazon or whatever, those tenants are actually driving those centers.
Well, it's
Yeah,
also restaurants, right? It's like
Yeah.
reimagining these malls. It's like there's a business plan out there, demalling, where they're basically taking them, you know, these old tired malls, knocking half of them down, creating kind of a Main Street concept with restaurants and entertainment, destination
Workplace.
retail. You know, it's, you know, one of the new buzzwords, but it's experiential retail
Right.
is what people are after. So, you know, we've definitely seen a lot of business plans where people are coming in and trying to reimagine retail. And I don't think anyone would argue there's just too much retail right
That's what I
now.
was gonna say.
And so, you
It's
know,
going to get smaller,
it's gonna get
and I
smaller.
think
But
that
in-
industry
in-
has to really figure out how they can drive traffic, whether it's entertainment or other things, to their locations.
I don't think every mall can be repurposed to restaurant and entertainment. I mean, that's the problem is that everybody does have that business plan. And to Brett's point, you need the right sponsor, you need a lot of equity, and you need to make sure that your location is the right location.
It's like the suburban office space. A lot of the suburban office space in New Jersey and Westchester is being repositioned for residential rentals.
Because there's no
There's no-
long-term rent growth there, basically.
And there's affordable
and there
housing,
hasn't been
particularly
for-
in New Jersey, there's affordable housing mandates, so people need to find places to put that housing.
but you have to be in a municipality with smart government that will embrace those changes with zoning, because
Yep.
it's not always, it's nice to say we're going to turn office buildings into residential, but it's a lot more, it's challenging.
What about an area which I haven't discussed, gaming? Would you lend to institutions with gaming, or is that a no-no?
We don't do any.
We don't
do
do it.
any gaming.
We don't either.
Yeah.
Okay, and the last question.
How about a better last question?
No, this is the last
Ronnie will
question.
find you a lender.
Okay, this is the last question. The verticalization of the cannabis industry.
We won't lend to it. It's still
mean,
federal, so we can't do it.
We've done one, a facility in California. We actually did it with a lender based out of Canada. To Chris's point, I think most domestic-based lenders will
So
not.
what type of...
But it's been driving markets like industrial markets in other locations, right? It's driving retail markets in certain locations.
That's
So it's
why.
having an
That's why I'm
effect-
bringing out the effect of this.
It's having an effect whether you lend to somebody who's directly involved in that business or not. Real estate has been affected in many locations.
You know, there is a
Affected.
new
You're
cannabis
smirking.
store that opened up on 39th Street and Fifth Avenue, right from my office. It's owned by Mad Men Cannabis Company, and you know they're on Fifth Avenue. It sells limited products, okay, but the tenant, the landlord who has the building, got his rent over there.
In cash.
Okay? And probably in cash because that's the only way it can operate. So I think in summation, I would like to thank Mr. Levine for bringing this group of specialists to provide their insight on the capital markets update for the summer of 2018. I'd like to thank Ronnie, Chris, Tony, and Brett, and I'll see you next week.